If oil prices reach $150, who wins? The fragility of the global energy system. Oil prices, if they reach $150, this is not just a market movement. This would be a test of the fragility of the global energy system. The world economy is built on oil. Transportation, industry, logistics, agriculture, chemicals, all of them depend on the same resource, oil. And today this system is under the shadow of a war in the Middle East, the United States, Israel, Iran. The tension between these three countries is not only a military issue, this is a potential shock for the global economy, because about 20% of the world's oil passes through a single narrow passage. Welcome to Finance Historian. Stories behind money, markets, and empires. To support the channel, you can subscribe, like the videos, leave a comment, and share them. Thank you. The Strait of Hormuz. Every day, roughly 17 million barrels of oil move through this narrow waterway. One crisis, one attack, one tanker. And this flow could stop instantly. If that happens, oil prices do not simply rise. They explode. And markets know this very well. In energy markets, sometimes a single piece of news is enough. A missile report, a tanker attack, a military exercise, and prices can jump within hours. Because the oil market is not only about supply and demand, it is also the price of risk. Traders, investors, and energy companies price future danger. Today, that is why every tension around the Strait of Hormuz echoes through global energy markets. Because everyone asks the same question. What if the flow stops? What if tankers cannot pass? What if the war escalates? And at that moment, oil is no longer just a commodity. It becomes the nervous system of the global economy. The impact of war on energy markets. The operations launched by the United States and Israel at the end of February 2026 targeted Iran's nuclear infrastructure. These operations may be militarily limited, but from the perspective of energy markets, they are extremely sensitive. Markets do not react to the war itself, they react to uncertainty. Because in the energy market, the only thing that determines price is not supply. Risk also creates price. A tanker attack, the possibility of a strait being closed, a missile strike, and the market reacts instantly. The oil market can move 10% overnight, sometimes more, because the energy market is not only economic, it is psychological. For an investor, the most dangerous thing is uncertainty. And war is the environment where uncertainty is most intense. That is why every military movement in the Middle East is watched closely by energy markets. A radar image, a military convoy, a naval exercise. All of them can affect prices. Because timing is critical in the energy trade, tankers are scheduled months in advance. Refineries plan production weeks ahead. Insurance companies calculate risks. And when any link in this chain breaks, the market feels it immediately. Tanker insurance prices rise, shipping costs increase, supply security is questioned. That is why sometimes the impact of war does not come from oil wells. It comes from panic. It comes from expectations. And the market knows one truth very well. In energy markets, fear can sometimes create prices faster than an actual supply loss. The Strait of Hormuz, the narrow passage of global energy. The Strait of Hormuz is not just a sea route. It is the narrowest point of the global energy system. About 1/5 of global oil trade passes through it. Saudi Arabia, United Arab Emirates, Kuwait, Iraq, Iran. All of their exports use this route. Now imagine this. What happens if this passage closes? Suddenly, 17 million barrels of oil per day disappear from the market. This amount is close to Europe's daily consumption. So this would not just be a regional crisis. It would be a global energy shock. Oil prices would rise rapidly. And in some scenarios, $200. At that point, the issue is no longer oil. It becomes a global inflation crisis. Because oil is not only energy. Oil is the circulatory system of the modern economy. Trucks run on oil. Ships move with oil. Airplanes fly on oil. Agricultural machinery uses oil. Fertilizer production depends on petrochemicals. Plastic production depends on oil. So when oil prices rise, gasoline is not the only thing that becomes expensive. Everything becomes more expensive. Transportation costs increase. Food prices rise, industrial production becomes more expensive, and most importantly, central banks face a difficult dilemma: control inflation or protect economic growth. That is why the Strait of Hormuz is not just a geographical passage. This narrow waterway is one of the most sensitive nerve points of the global economy. What happens to the United States if oil reaches $150? At first glance, the United States seems like a winner, because the U.S. is one of the largest oil producers in the world. Especially shale oil production becomes far more profitable at high prices. $150 oil means serious revenue for American energy companies. New drilling begins. Investments increase, the energy sector expands. But the story does not end here, because the United States is also a massive consumer economy. The heart of the American economy is the consumer, and consumers are directly affected by energy prices. Gasoline prices rise, transportation costs increase, airline tickets become more expensive, food prices go up. The entire economy is affected through a chain reaction. And the most critical point is inflation. When oil prices rise, inflation in the United States rises as well. At that point, the Federal Reserve faces a difficult choice: raise interest rates or support the economy. And at that moment, when oil prices begin to influence not only the energy market, but also monetary policy. Israel's economy, the financial cost of war. For Israel, the situation is more complicated. Because Israel is not a major energy producer, it is an energy importer. So when oil prices rise, costs increase directly. But there's another cost: war. Modern warfare is not cheap. Missiles, air defense systems, military operations, logistics, all of them require billions of dollars. If a country fights a war while also facing an energy price shock, its budget balance can deteriorate rapidly. Tourism declines, investments slow down, market confidence weakens, and economic uncertainty grows. That is why rising oil prices are not just an energy cost for Israel. They are economic pressure. The oil price. Paradox for Iran. For Iran, the situation is different. It has been under sanctions for years. Oil exports are limited. The financial system is isolated. But when oil prices rise, a short-term advantage appears for Iran. It sells less oil, but at a higher price. This can increase government revenues. These revenues can be used to finance war efforts. However, there is a critical question. Is this sustainable? The answer is most likely no. Because if war continues for a long time, infrastructure is damaged. Oil facilities can become targets. Logistics can be disrupted. And production declines. So high prices are a short-term advantage, not a long-term solution. The domino effect on the global economy. If oil prices reach $150, the effects spread in a chain. First energy prices rise, then transportation costs, then production costs, then consumer prices, and finally, inflation. This process creates a domino effect. European economies come under pressure. Asian industry faces a cost shock. Developing countries struggle with their energy bills. For many countries, energy imports expand trade deficits. Currencies lose value. Borrowing costs rise, and global growth slows. So an increase in oil prices is not limited to the energy sector. It affects the entire global economy. Market psychology, the invisible factor. There's another important factor in energy markets: psychology. Sometimes price is not determined by supply, but by fear. When investors begin to avoid risk, markets become even more volatile. Capital moves toward safe havens, gold, the dollar, bonds. Stock markets become volatile. That is why oil prices are not just economic data. They are the price of geopolitical risk. Conclusion: who wins? When oil reaches $150, there are some winners: oil exporters, energy companies, certain producers. But the number of losers is greater: energy importing countries, consumers, industrial companies, and the global economy. The United States partially benefits, but consumers lose. Iran may gain in the short term, but long-term economic pressure increases. Israel faces significant financial costs. In the end, the real winners are very few, but the risk spreads to everyone. And when oil reaches $150, it becomes not only a story about energy markets, but a signal of the fragility of the global economy. Because in energy markets, a small spark can sometimes turn into a fire that affects the entire world. If you enjoyed the video, don't forget to subscribe to the channel, like the video, leave a comment, and share it. You can turn on the notification bell to stay updated on new videos. See you in the next video.